Okay, it's going on for 8 minutes, yeah.
Okay, there
But
you go.
it's showing up on the other one, but it's not showing
Refresh
this
it.
one, yeah.
It should show up now.
Not on this one, yeah. But I'm gonna go and I'm gonna to my lecture and
All right.
okay.
No longer. I'll tell him you gotta go.
All right. I would like to apologize for the delay for the last 8 minutes. It has been some technical problems, but now we are back, and we will continue with chapter 10. Sorry. The plan was that we would do some exercises for chapter 9. Since we are late, about 8 to 10 minutes, and we have only Brother Darian here, so we will go with chapter 10. Chapter 10 is about long-term assets. So, Brother Darian, what does that mean, long-term assets?
Actually, like the money saved them for like extended period of time, or like future wise.
Say it again, one more time.
I said money saved them for like a long period of time, like future wise.
Those are the assets that are supposed to be used for more than 1 year. More than 1 year. Such as land, building, equipment, machinery. Okay? And so long-term assets have the following characteristics. They have a useful life of more than 1 year, and they are used in the operation of the business, and they are not intended for resale to customers. That means you are going to use them for their mostly for their entire life, yeah, or until you get to you use them until you get to their residual value. All right. Long-term assets are generally reported and valued at their carrying value. In other words, they are recorded at their book value. Book value means the original cost or the historical cost minus, guess what? Let's say if you bought a building and you want to record it today on the balance sheet. So how would you record that building? You're going to say the original cost minus accumulated depreciation. All right, that is the book value. So assets are long-term assets are recorded at their carrying value, which is the book value. All right, book value is the historical cost minus accumulated depreciations. Now, when we talk about assets impairment, what does that impairment mean?
Assets impairment is be like
that they have been used.
Yes, sir.
So you keep using them until they get to their residual value. All right, and so occurs when the carrying value of the long-term asset exceeds its fair value. That means you are using it more and more and more and more until you get to the scrap value. All right. Now, in terms of recognition of the assets, for example, when you buy the assets, when you buy it or when you acquire it, it's called an expenditure. All right. When you buy it, it doesn't mean that it's an expense. Be careful. Expenditure means that you spend the money in order to acquire the assets, and then once you acquire it, you're going to start using it. Yeah. But as you use it, it becomes what you use is an expense. All right. So they are called capital expenditure. All right. That means it is the purchase or expansion of a long-term asset. That's when you buy a long-term asset. If you buy a building, if you buy land, that's a capital expenditure. All right. If you buy long-term assets, yeah. And then also you have the revenue expenditure. That's what you spend on the assets, to make it useful, all right, to make it producing some products for you. All right, like for example, in the building, what does it take to, what do you spend on the building to make it running smoothly? Like if you have offices in it and people are renting spaces in it and people are using it, you have to maintain it. So the maintenance is considered a revenue expenditure. All right. Now, capital expenditures includes all the resources, all the steps that gets the assets ready to be used. All right, it includes outlays for plant assets, natural resources, and intangible assets. What does that mean? Outlays. All the conditions necessary to get it to start to work. Okay, maybe you got to build some base, cement base. You got to fix it to the ground. The shipping and all of that. All of those are the outlays. All right, for the asset to get to start it to be used. All right, and then you have additions and betterments and extraordinary repairs. When we say additions, that means enlargements to the physical layout of the plant asset. Maybe you add a garage, maybe you add some new doors, you add a new hallway, you add a kitchen, you add like that. That's additions. And then also you have improvements. All right, improvements to a plant asset, but not an addition to the plant physical. See, when we say improvements, okay, maybe you enhance, this door. You enhance it. You put put an electrical door or like that. Yeah, that's an enhancement. And then you have extraordinary repairs also. All of these, by the way, are capital expenditures. All right. The additions, the betterment, and extraordinary repairs, those are capital expenditures. All right. Maybe in some of your multiple choice questions or true and false questions, you may see one of those. All right. Okay. Let me move on to the next one. Acquisition cost of property, plant, and equipment. Now, when we say, let's say you bought a machine, okay, and that machine is like, have you been in a garage where they fix cars? The lift, what do you call that? Huh?
You can look like a little forklift.
Yeah, the one that you put the car on and start.
I know you're talking, but I can't think of it.
Let's call it car lift, yeah. So what do you think the cost of that? Is it that, just the equipment when you buy it and you move it to the place?
Nah, it's like, not just the equipment. It's like you pay like the shipping price.
The shipping part.
And then like, of course, the parts they go with it.
Say it again.
Like now the shipping price, but like parts.
How you doing? Good morning.
Good morning. Come in.
Sorry.
So it will include the price, then the catalog price when you order it, the shipping, the insurance, the digging in the ground, the work it takes to, all of those steps necessary to get it to be used. So that is the acquisition cost. So acquisition cost of the asset include the purchase price plus additional expenditures, all right, such as freight, installations, etc. All right. However, if you have an interest, if you purchase the asset through a loan, all right, and you have to pay interest on that loan, that is not included in the cost of the assets. All right. Small expenditure for long-term assets may be treated as expenses if they are not material. Like if you just want to do a painting, okay, that's considered expense. If the machine broke a little bit, but if you do an overhaul to the machine, that's considered a capital expenditure, all right? Or part of the acquisition cost. Now the land expenditures that should be debited to the land account include purchase price of the land, commissions to real estate agents, lawyers' fees, accrued taxes paid by the purchaser, cost of preparing. All of these costs, as you can see on this slide, they are considered part of the land. When you purchase a piece of land, it includes all of these. Yeah.
How do you purchase land though? Like as far as like you just go to the bank,
No, if you first of all you got to find,
right?
you know,
right.
and then if you can't pay it from your own, then you have to make a loan, probably a mortgage, or yeah. But the process is long process, okay? Because you can't just go and
Right.
buy like a house. You're buying a house. Buying a house, you have to go to a title company. Okay, you have to hire. There's a lawyer. The lawyer will get the title for you. Once you get the title, then you will have also appraisals. You have people will come and check the house for you and to make sure it's in a good shape. It's a long process. It may take you at least maybe 2-3 weeks to buy it. Not just
Land?
yes, sir.
I can wait 2 or 3 weeks to buy
The
some
land and the house. Well, you got to get it cleared. Yeah. What if you buy it and somebody else still have a title for it? Yeah. So you got to pay money for the title company. It takes them a few days, to clear for you. Once it's cleared, then okay, the bank is involved. The bank will go to the title company. You both will where the lawyers are. Okay, it's not an easy process, yeah. And before you buy the piece of land, you may have to inspect it, you may have to appraise it, you may have to, when we say inspection, that means maybe they will have to inspect the ground or something. That's what they do to houses. Yeah, they expect, there's an appraisal, and there is sometimes you may have to even check the bases of the house, the ground, those things, yeah. It's not, have you gone through a process of buying a house?
As far as like mortgage and stuff, yeah, but I haven't been to the bank or nothing.
Yeah. When we purchased our house, we had a mortgage, yeah. Mortgage, and all of these processes are.
More of a renter,
Yeah.
like I rented houses out. But
Are you rented houses? Yeah, that's totally different. Yeah.
easier,
Yeah.
They just want money. They just want to see if you can,
Yeah, that's totally different. Yeah.
I know, sure.
So all of these expenditures are considered part of the price of the land. All right, and then when you have improvements to real estate, when you just improve it, such as driveways, park lots, and fences that have a limited life, are subject to depreciation. They are recorded in an account called land improvement. So they are not part of the land, but they are called. There is a special account called land improvements. Okay, like these things. Yeah, if you add the fence, if you add the driveway, if you add all of those. Yeah. Okay. When a company buys a building, the cost includes the purchase. I think I'm repeating the same thing here. I think we're spending too much time on these because there's my intention for this thing is to go to the depreciation. All right, so I'll let you read this.
Forrester's on
There's
his
some
way.
slides, huh?
Forrester's on his way. Goodrich. He's on his way.
Okay. The equipment, the cost of equipment includes, see when you buy equipment, all right, includes all expenditure connected with the purchasing of the equipment and preparing it for use. Like what we said, also sometimes you buy a group of things at the same time, group purchase. You pay a lump sum amount for them. It's like if you buy a building, and the building has a garage, okay, and it has you buy the land, the building, the garage, and maybe a little bit of surrounding area altogether. It may have a shop on it, the land. So you have a little bit of a house and a shop, or the garage, and may have a little bit parking lot also. So you buy all of these in one lump sum amount, and we will little bit find out how do you, if you pay $100,000 for this whole thing together, how much of this, if you want to allocate this to the building, to the land, how much belongs to the land, how much belongs to the building, how much belongs to the garage, like that, out of the lump sum that you paid. So we're going to look at that shortly. All right, here is the what I was looking for. Yeah, what does that mean? Depreciation. What is other than what it says in this slide? It refers to the allocation of the cost of planned assets over its estimated useful life, not the asset's physical deterioration or its decrease in market value. It's the usage of the asset. Yeah, depreciation is the usage of the assets. So, or the decline in its, not market value, decline of its historical cost, its original cost. The more you use it, its original cost will go down. So you look at the book value of the assets, which is the total cost minus accumulated depreciation. That will give you the, so the larger the accumulated depreciation, the lower the book value. Okay. So the factors that have to do with, or that have to do with the depreciation, the major factors that limit depreciable assets useful life are physical deterioration and obsolescence. Can you read those two things? Those are the ones that limit the life of the asset. All right. Physical deteriorations. It is what? It is getting is being used. All right. And when it's used, it loses some of its value. And obsolescence is become absolute. That's what it means in simple words. Yeah. Because see, if you have this telephone, for example. Okay, the more when you first you buy it, brand new, it looks so good and shiny, and then the more you use it, as more you use it, after maybe 6 months,
it wears down.
it is smudged. It's being, that means it's being used. Yeah. So that's, it has a physical deterioration, and it has obsolescence also. Yeah. Okay. Depreciation is recorded even if an asset increase in value. Well, how does an asset increase in value when you use it? But
how when you use it?
Even though you are using it, but it may increase in value. How?
I don't know. Like being profitable or like being like very like effective, I guess.
Well, I think maybe when you improve it, it increases its value.
Yeah.
You know, when you add some, maybe you paint it, you make an overhaul for it, and
just like when you get a car, you know, you add your little touch to it or whatever, you know.
yeah, and
And you know what you do. And,
but you still have, even though you still have to record depreciation. Why do we care about depreciation?
I mean, everything gets old.
Why do we care about see? If you have lots of machines at your workplace or in your business, it is very, very important that you get the depreciation, because you need that depreciation expense for tax purposes. The more expenses you have, the less income, the less the taxes.
What do you mean by that though? Like as far as like it's gonna get old, so just have some backup money or something?
No. See, the taxes depend on the income. The taxes you pay. The more taxes you have, I mean, the more expenses you have, the less income. So you remember the income statement: revenues minus expenses. If you have a big income, that means you have to pay taxes, right? But if you have a smaller income, you have to pay less taxes. Do you understand what I'm saying? No, you don't.
Yes, I do.
Okay, yeah. So when you have too much expenses, it makes your income smaller. Therefore, you have to pay less taxes. Yeah. So that's why you need to look for that depreciation expense. That's one reason, you know, one of the reasons. Yeah. The other reason is when you sell an asset, you got to look at its book value. If you sell it below its book value, that means you have a loss. You have to sell it, you have to know what the book value is. So when you sell it, you have to make some extra money on it. Yeah. You sell it with above the book value. The book value is your cost minus accumulated depreciation. So when you that gives you what the book value is. So if the book value is for a car is $600, and you sell it for 500, you know, that means you made a loss on that. You lost. But if its book value is 600 and you sell it for 800, then you made a gain of $200. Yeah. So that's why we have to look for depreciation, especially if you have lots of equipment at your workplace. Okay. The factors that we must consider in computing depreciation. Number one, we have to know what the cost is of an asset. You have to know the cost. Now, like we said earlier, the cost is not just the purchase price. It includes all the steps necessary to get the assets to be used, ready to be used. That's the cost of the assets. The net purchase price of an asset plus all expenditures to get it in place and ready to be. That means the shipping, the handling, the insurance, the digging in the ground to fix the machine, the inspection, all of those together are considered a part of the cost. Okay. The other thing is you need to know is the residual value. Okay. The residual value, or is called salvage or disposable value or trade-in value. It's the same thing. Residual value, salvage value, or trade-in value. That means the value of the assets at the end of its useful life. So if an asset costs $10,000 and is supposed to last for 10 years, and in year 9 or 10, what is the value of that asset? Okay, that's the residual value. And then the depreciable cost. Depreciable cost is the cost minus salvage value. Okay, depreciable cost is the cost minus salvage value or residual value or disposable value. That is the depreciable cost. And then you have to know the life, the estimated life of an asset. So you have to know the cost, depreciable cost, which is the cost minus residual or disposable or salvage value. And you have to know the life of the asset. And the life of the asset, that can be in years or in units. The life. For example, a truck. If you buy a car, okay, the car life, how would you value the life of the car?
The miles.
The mileage, either 60,000 miles or 80,000 miles, that's the life of that, or maybe 10 years. So it's either in years or in units. If you have an oil well, that's a natural resource. What is the value of this? What's the life of this oil well?
But how can you tell, like, I don't know.
It depends on how deep the oil go down. So
Yes, sir. You're right. The gallons, or how many barrels it has in it. Yeah. A forest that you have been used for wood. What's the life of that forest? If it's only used for wood, the one on a commercial basis, the wood that they cut and they make it nice and sell it for wood.
It depends on how many miles long.
How miles?
What trees? How many trees they have?
How do you measure the trees?
I don't know, like.
how do you measure the length of the trees?
I guess when you chop them down, then you measure 'em, I guess. Well, no, you know how long.
Have
is-
you ever
how
heard
tall
of
it's
the,
supposed to
have
be
you
when,
ever heard of
like,
the
you
board
use it?
foot?
A board?
Board foot, yeah. By board foot, yeah, that's what we call it, yeah.
Okay.
All right. So you have to know these four things: the cost, residual value, depreciable cost, and the estimated useful life. Like we said, the life can be in years or in units. Yeah. All right. There is also what you call accelerated methods of depreciation. These accelerated methods, that means the asset may have been used highly in maybe its first year or 2 or 3 years of its life. Do you know of any asset that's been used highly in its first 2 3 lives and then become maybe absolute or obsolete? What kind of assets that they are used heavily in their first years of life? How about computers, cell phones? You know, by the time you
Electronics?
yeah, we must say electronics. Yeah. Accelerated method of depreciation results in larger amounts of depreciation in the early years of an asset's life than in later years. Yeah, I mean, when you got iPhone 7, after about 2 3 months, immediately they have the something else, 7 Plus. I mean, not Plus. There is something else. They have IS or something. I don't know what they
I
call.
don't even remember. They didn't,
Yeah.
because they had came out with like 4 of them back to back.
Yes.
Yeah.
Uh-huh.
10, shit, 8,
Yeah.
right.
I mean, you know, all of that is useless, really. You know, that extra things, as long as you have the original one, you know, all of these improvements are unnecessary. But they are making us addicted to them. You guys, the young generation, you are addicted to these cell
I'm
phones.
excluded. I went like a whole month without a phone, and I could have went more than that.
Oh my God, he went the whole month without the phone. How did you survive? How did you survive for a
I went from 8th grade to sophomore year without mine.
See, all what you need, you know, some people still have that old that you open and you
With the flip phone.
Yeah, flip phone. and they do the job and they're surviving handsomely. People, yeah.
At Granny flip phone, they got one
Yeah.
game.
They, you know, the only reason why I bought this phone because I see all you guys, the students, have just a show. That's all.
It's real though.
Not trying to-
Just a show. Believe me, I don't use it at all. I find sometimes when people call me, I see the messages on it. Sometimes I respond, sometimes I don't. I put it in one room and I sit in another room. And when I'm in classes, you know, our class policy, he can tell you, Brother Darian, what is the class policy for cell phones in the classroom.
If you get caught with the cell phone, you'll be asked to leave the class.
Yes.
Or if
And
the office goes off, you'll be asked to leave the
I keep mine in the office all day. I don't carry it. I don't. Yeah.
Now, if his cell phone goes off,
If mine goes off, then the class is over too. Yes, because I don't keep it with me. I leave it in the office. Yeah. But not now. Okay, but not now. Okay, so these are the accelerated. Thus, depreciation charges will be highest in years when the asset is newest and when revenue generation from the asset is likely to be highest. So those are mostly, I would say, electronics. Yeah. That fit within this kind of business, Group this large companies group similar assets such as machines to calculate depreciation. So if you have a bunch of machines, you know, you don't want to do a one for each. It's going to be time consuming, and so large companies group similar assets such as machines to calculate depreciation. It is often necessary to calculate depreciation for partial years because assets are often purchased mid-year. But like you said, it's very, very important to calculate the depreciation. Very important. It has an effect on the amount of taxes that you have to pay. So if you buy an asset in the middle of the year, that means you have a 6 months worth of depreciation for the rest of the year. Yeah. Okay. And it's important for taxes too. Like what I said, for the government authority also. Okay, sometimes, see, once you use, we're going to learn in a few minutes the depreciation methods. How do you calculate depreciation? Once you choose the method, all right, you can't change it. You have to get approval from the government to change the method of depreciation. Yeah, you can change from year to the next year, but you cannot change within the accounting period. All right, let's say you chose straight line depreciation January 1st. If your fiscal year starts January, then 6 months down the road, you say, oh, I don't want to use the straight line method. I want to use the declining balance method. You can't do that. If you get approval of the IRS, then you might be fine. Yeah. But you won't get it. Yeah. Okay. Disposal of depreciable assets. So when an asset is totally used, what do you do with it? You don't just throw it away. You have to do a general journal entry for that. Yeah. And it's like we said with adjustments, accruals and deferrals, you have to do journal entries. You can't just go and change the numbers. Yeah. Same thing if you have a truck that you have been using for the business and it's about time to get rid of it. You can't just leave it there, and you have to do a journal entry for that. Yeah. Now remember, the accumulated depreciation account is a contra account, and it has a credit balance, and then when you get rid of it, you're going to debit your accumulated depreciation. You're going to also credit the cost, the assets at cost. And then you may have a gain or loss on disposal. If you still have some life, or if you used it more than its expected life, that means you have some gains on it. Yeah. If you used it less than expected, you used it for 9 years instead of 10 years, I mean you lost some of the usage of that asset. And sometimes also you may exchange assets. Exchange may involve similar assets, such as an old machine traded on a newer model, or dissimilar assets, such as cement mixer traded on a truck. So you may exchange similar assets or dissimilar assets, and that's going to make a difference. We're going to see in a little bit why it will make a difference, whether they are similar or dissimilar assets. Yeah. In both cases, the purchase price is reduced by the amount of a trade-in allowance. That means if one of them cost $100 and you exchange it for something with $80, that's the difference. That's the trade allowance. Yeah. So if the trade-in allowance is greater than the assets carrying value, the company realizes a gain. So if you have an asset that's worth $800 and you exchange it with another asset that has a value of $1,000, that means you realize a gain of $200. Yeah, and vice versa. If allowance is less, it suffers a loss. Yeah. Okay. How about natural resources? So far we have been talking about physical assets. Well, natural resources are physical assets also. So what is the appropriate word for instead of depreciation for natural such as a oil well or a wood or a water well. So instead of depreciation, what is the word, appropriate word for their usage? We don't say an oil well has been depreciated.
It ran out.
No, there is another word.
Extinct.
No. The word is not amortization. The word is depletion. Sorry,
Depletion.
Yes.
Yeah. Okay.
depletion.
It's depleted.
Yes, sir. So when you use an oil well until it's fully depleted, that's what you say. Or if you have a wood where you cut the wood from it, the forest, that's specifically for wood. When it is totally used, it is fully depleted. Yeah. And in a minute, we're going to look at the intangible assets. So natural resources are long-term assets that are converted to inventory by cutting, pumping, mining, or other extraction methods. So if you have a gold mine, or if you have a diamond mine, those we'll talk about. Yeah, you use them until they are fully depleted. So there's mining or pumping if it's an oil, for example. Cutting, maybe like a wood, like we said. Yeah, all right. They are recorded at acquisition cost. So if you buy a forest, you will have to record it at its original cost. If you bought it with $1 million, so you would have to debit that assets with $1 million. Yeah, all right. The useful life of the plant assets used to extract the natural resources may be longer than the time it will take to extract the resources. So if it's a diamond mine, it may have a useful life of 100 years, but it may take 40, 50 years only to extract all the diamonds from that land. Yeah. Okay, let's see. Depletion, that's the that's the word there. Depletion refers not only to the exhaustion of a natural resource, but also to the proportional allocation of the cost of natural resources to the units. See, you might want to say in specific year how many board feet was extracted from the land in 1 year. So there is a formula for that. You're going to take just very similar to the original one we said earlier, the cost minus accumulated depreciation divided by the life of the assets. Yeah. So the cost of the wood of the forest minus the residual value. Okay, that's the scrap value or the value of the assets at the end of its useful life, divided by the estimated units or number of units. So if you have a forest, okay, that costs you $1 million, and it has on it 10 million board feet or 100 million board feet of wood on it. That's the whole thing in it. Yeah. So how much units were extracted or depleted in year 1? So you're going to take the cost minus residual value, all right, and you divide it by estimated number of units, all right, and then that will give you how much. This if it's a straight line, yeah. All right. Okay. Development and exploration costs in the oil and gas industry. How about the while you are trying to look for oil, is that considered part of the cost of the oil well? It depends. Whether it is, depends on whether you find it or you don't find it. Yeah. If it is successful efforts accounting under this method, the cost of successful exploration is the cost of the resources. So if you find it, the oil well, everything you spent, that becomes part of the cost. So that means your equipment, your experts, your whatever it takes while they are looking for the oil. And if they found it, that's the cost. If they don't find it, it depends on what they may have a transportation costs, but it will not be debited to the cost of the oil well, yeah. But it will be expenses of whatever, maybe gas, maybe transportation, maybe
Wages,
food,
you gotta
maybe
pay the crew.
yeah, these things, yeah. So if it's successful efforts, then all of those costs that you incur, they will be part of the cost of the well. Okay. So it is recorded as an asset and depleted over the resource's estimated life. The cost of unsuccessful exploration is written off immediately as loss. If you don't find it, it's written off as a loss. Yeah.
Big L.
Yes. Have you ever worked for an oil company? For what's the name of that?
This pen I got from my oil company though.
Huh?
Oxy.
No, there is another company.
Halliburton.
Yes, they make lots of money.
Oh,
those
my
guys.
brother used to work for Oceanair. He was way in Africa.
Yeah. Halliburton they make lots of money, but they work hard. They make you work hard. The first time maybe you have to stay 2-3 months out of home, yeah. With them exploration and I don't know what they do, but
My brother told me the phone. He said the ones that go out there and work make more money than the bosses that be back at home.
yes.
Oh, that's fair.
Yeah, I know a guy, an Arab guy. He has been working for long. He
That's
has
a
many
dangerous
chances.
job though.
He had many chances to be a manager, but he doesn't want because he doesn't make money as much as the ones who are. So he likes to be outside doing the work. He makes lots of money than the boss who's sitting in the office. Yeah. And but they work. They work a lot. I mean, sometimes they may need you in the middle of the night. Sometimes they may, while you're doing, your work at home or in the middle of something, they call you, and you have to go. Yeah, you have to go. But the benefit is a lot. They give you good money. I know some people who work there for them, yeah, from the Arab people, yeah. Okay, and under the full costing method, under this method, all costs of exploration are recorded as assets and depleted over the estimated life of the resources. This includes the cost of unsuccessful exploration, such as the cost of dry wells and those things. Yeah. But they will go into the specific assets that you buy. If you buy a dry well, okay, it's going to be added to the dry well, the machines, but not to the because you didn't find oil there. Okay. Now we come to the intangible assets. Those are the assets that you cannot touch or see. What is the appropriate word instead of depreciation for the intangible assets? It's not depreciation, it's not depletion, amortization. Okay, for the intangible assets, the appropriate word is amortization. So the physical assets is depreciation, the natural resources is depletion, and the intangible assets such as amortization.
Amortization.
Amortization. Yes, amortization. They are amortized. And can you give me a couple of examples of those intangible assets?
A trademark,
Trademark,
copyright.
yes.
Let me think.
The what do you call when if you build if you own a McDonald's, you have to use something. I forgot what they call it. Yeah. And goodwill also, but not goodwill industry. There's something called goodwill. Also, that's an intangible. Franchise.
Oh, a franchise.
Yes, sir.
Okay.
That's the word. Yeah, franchise. Yeah. So if you have own a McDonald's,
What was the word you said before that?
the goodwill.
Goodwill. Okay.
Goodwill. See, an asset may be valuable, not because of the location. And maybe an asset may be highly valuable, maybe because of the location, or maybe it has some assets that are highly valuable assets. Yeah, that's a goodwill. Okay. Intangible assets are accounted for at the amount that a company paid for them and should be included on a company's balance sheet only if purchased from another party at a price established in the marketplace. Well, if you decide to build a McDonald's, okay, if you decide, I know an Arab guy used to own, I think, maybe one or two of those. Yeah, but those are franchises considered. Yeah, he have to buy that from the company. Yeah, and then he would have to buy all the material. So you got to buy cups and all of those spoons and everything. You got to buy from. That's the benefit for those guys. Yeah. If you want to use their logo, yeah, that means you have to use everything they have. Yeah. I tell you, in Jordan, that's being recorded. Yeah, but not now. When McDonald's was open in Jordan, and when people want to go to a special nice place, they go to McDonald's. Yeah, but not anymore. Yeah, now they have all of these kinds of franchises. Yeah, they have McDonald's, they have Kentucky Fried Chicken, they have Popeye, they have everything. Yeah. So
that would be considered like it wouldn't be considered fast food restaurant. Enjoy.
for them at that time.
Oh, all right.
Yeah, at that time. Yeah, but now
So
they
everybody kinda
are used to it now.
Yeah, they ain't worth nothing.
Yes, you got it. When I went to Saudi Arabia, they have some place like McDonald's. It looks like McDonald's, but it's not McDonald's. But they have the best fried food. I mean, you can eat 10 pieces, fried chicken, and tasty and crunchy. It's not like if you buy from fried chicken. I mean, it will break your teeth when you have to. That thing, if you eat it, it's so hard, it break your teeth. Yeah? But that thing is really crunchy and.
Oh, you talking about the gristle?
Yeah.
Oh yeah, I tear that gristle up.
But on those places, the skin is even tastier than the meat. Really, it's crunchy and dry and.
Oh yeah.
There is a place here they do that on an Islamic way. Is the meat is done on the Islamic way and it's very tasty too. Yeah. I mean if you kill the animal, I know that is being recorded. Yeah, but in the public. But if you kill the animal like the chicken and the blood stays within the meat still in it, it doesn't taste as much as when you kill the animal and you drain the blood.
Yeah, you gotta
It's
drain
really
that
the best
blood
meat
once
in the
you
world.
cut the
When you
hero.
drain the blood from it, it's the best meat, and it's expensive. Yeah. So if there are places in Dallas, where they kill the lambs and the goats, and it's killed in the Islamic way. Yeah. That means all the blood is drained, and then you have left with the fresh meat, nice meat. Yeah.
Gotta take all the fats out
If you
too.
buy a piece of steak from Walmart, or something, if you clean it, put water on it and clean it, it becomes white. It's all full of blood.
Mm.
Yeah. Try sometime, buy one and see if you clean what happened to it. Yeah.
Shit, I done gutted animals before.
So what you mean, like when you get like cook it when it's white?
It already has lots of blood in it. You know, residual in it. Yeah. But if it's killed the Islamic way, even the Jewish way is good way too. They do the same, the Jewish people, yeah. Like the Muslims, yeah.
Us country folks do it the same way too.
They do that way.
Mm-hmm.
You know, there are Muslims now, they go to the farms here, somewhere in East Texas, and they kill the animal the way they want it for them. They slaughter it for them, and they bring it home, yeah. But we have to go to Dallas when we buy the meat from Richardson.
Oh yeah, Richardson got that good food.
Yes.
See, that's all we eat back at home.
Richardson has groceries, Arab groceries, African groceries, Middle Eastern, European. We go to, there's a big place. I mean, you have the Arabs, you have the Sudanese, the Middle Easterns, the Ethiopians, the Indians, the people from Ghana. They go and buy from a big place. Yeah. It has the traditional food. Yeah. Well, anyway. I think here's the goodwill that I was telling you about. I think that's all what I needed from this chapter. But next time we're gonna do. We haven't I had plans to practice chapter 9.
Yeah.
To do exercises, but nobody. It was only Brother Darian here, and we didn't.
Yeah, that was me. See, I had to wake myself up out of my sleep today because
Yeah.
my phone
So,
was long. I don't know.
I hit the snooze button like 6, 7 times.
This might be the last chapter, guys. Chapter 10. I think we covered enough what we covered in regular class semester. But we're going to do some practice. We're going to practice chapter 9 next time, and we're going to practice chapter 10. But I want you guys to catch up. Please do catch up on the assignments, the cases, and the homework. And you guys give me the exams. I need the exams, and
Oh, did you go over the thing so I can click on this?
I think you gave me. Okay, thank you.
I gave you all my stuff yesterday.
Yes, sir.
I just gotta do my case studies.
We can go
And
over there
chapter
and sign up for
Don't
count
forget case studies now, guys.
I
Okay.
gave you mine last
What are
Thursday.
your chapters, Mr. Desmond?
There's one of them right here.
What happened to the rest of them?
They're
The one too.
in my car.
What are they doing in your car?
This
I ain't
is
get
the
the 4, 5, 6.
All right, let me stop streaming here.
You recently just make sure. Hey, Doc, we can